everyone, and welcome to the Latinx Business Podcast. I'm your host, Randy Gomez, and if you're looking to demystify the world of business through the raw, authentic stories of Latinx entrepreneurs, you've come to the right place. As someone with an MBA and an IRS enrolled agent license, I've spent years helping freelancers, partnerships, and S corporations navigate the often tricky waters of the U.S. tax law. Now, I'm bringing that expertise and passion to this community right here. So thank you for tuning in, and you know what? It's time to talk business. Hey guys, welcome back to another episode of Latinx Business Podcast, Tax Tip Edition. And today we're going to tackle down the new Donald Trump accounts that are to be set up by July 4th, 2026 for children between the ages of 1 and 18, right? So let's get into the details of it. This is a new custodial type of IRA that's going to be set up for children under the age of 18. If the child is born between 2025 and 2028, so January 1st and December 31st, 2028, the government will deposit a $1,000 one-time deposit for free. So definitely open up the account if your child is born between those 3 years. Now, any child under the age of 18 can still open up an account and deposit, and the parents can deposit their own money into the account and also invest that into the stock market. Now, the money does have to be invested in American equities, low cost mutual funds and ETFs. So no more than 0.1% of cost for those funds, which is a good thing because it's getting reinvested, in the American economy. Now, the seed money, $1,000 by the government. The Dow Corporation just announced that they're going to give $250 per account. If you're going to be able to get your child $1,000 plus an additional $250 that can start growing tax-free, why not? Open up the account. You will have to open up the account with the IRS. The form is IRS form 4547. Reach out to your tax guy or girl, and we will fill out the forms for you. Definitely ask them, inquire if they're going to be charging extra for this form or include as part of the fees they already charge you, because it is an additional form that is new to us and that we've never filled out, and that does involve additional time in tax preparation. Okay. Now, you cannot pull out any of the money once it's in there. If, once you put the money in there, it is in that account until the child is 18 years old, which at that point, the account is no longer managed by the adult or the guardian or the parent. It's managed, gets turned over to the child, and then it's going to follow rules of traditional IRAs, which means that, money you put into the account is not taxed, right? Because you use after tax dollars money to build that account. Now, the growth, so the spread between the money you put in there and how much it's grown, that is going to be taxed at the child's ordinary tax rate. If the child pulls that out when they're 18, they might be a super low tax bracket. But if they pull that out when they're in their 60s, they might be at a much higher tax bracket or lower tax bracket. Depends what happens with the individual's life. So tricky. Yeah, I think one, collect the free money for your child. 2, do you want to invest your own money in there? A lot of financial advisors are saying there's better vehicles to invest your money in at the moment, but it's still a good idea to start investing for your child at a very young age. One good thing about this Trump account is that, if they do take out the money when they're 18, or if they use it for a school, or if they use it to buy a home or to start a business, those are 3 exceptions that the accounts have, that they can be taxed at capital gains rate, which can be very low, especially if they're taking that money out when they're 18, 19, or 20 years old, for school or to buy a home and stuff like that, especially when they don't have that much, they're not earning a lot of income at the moment. It would be more expensive for some individuals to take that money out when they're already making 6 figures or at a much higher tax bracket. So there seems to be a lot of planning that needs to be involved in this. However, still open it. If your child is born outside 2025 and 2028, then, or if they were born before that or after that, you can still open up an account with them. I'm going to show you guys the form. The form is called IRS Tax Form 4547, and let's take a look at it. Okay, so we're on the IRS website, and this is just a draft. So this is, this can't be used to file the return yet, but I do want to give you guys an overview of what the form looks like. So part 1 is where the parent or guardian will put in their information. So name, address, and phone number, and email, and social security number. Child's information is part 2. So now we have the child's name, address, social security, birthday, relationship, and then you check off this box 5 if it's the same address as the parent or guardian. And then if you have 2 children, you fill out 2 different columns. If you have 4 children, then you would use 2 of these forms to fill that, to open up the account, right? These forms will be submitted to the IRS. The IRS would then transfer that information to the Treasury Department, and in May of 2026, the Treasury Department will contact the individuals on how they can set up those accounts, and then July 4th of 2026, then these accounts can start being funded privately by the parents or the guardians. Now, if your child here does qualify for the $1,000, you would check this box off here. So let's say, for example, we have a child that was born within the timeline, but then we have one child that was born one day after the timeline. So this child will qualify and this child wouldn't. So we will leave this one blank. And then down here in part 4, we have the information for where you sign as the guardian, and then your tax preparer, which would be myself. Down here, we will fill this out. So yeah, that's a quick overview of that. Again, I do think that saving for your children is essential, especially when they're really young. The max amount that you can put away in these accounts is $5,000 per year. That's supposed to be adjusted for inflation every year. But I would look at other avenues if you want to use this specifically for college savings. 529 plans, 100% tax-free, as long as it's used to pay for tuition. Custodial Roth IRA, that will grow tax-free. So a custodial Roth IRA, that is also post-tax dollars. So, and the only caveat to that is that you can't really pull out the money until 59 and a half. So you do have to leave the money in there long term. So it's a long-term strategy you're looking at for it to grow. But yeah, I hope that helped. We're also here. We provide an initial consultation as RG Taxes. So if you guys have questions about your current year taxes, tax forms, or if you want us to look at last year's tax forms at no obligation of you guys becoming our client, we're happy to do that. It's a 1-hour consultation. It does come at a fee, but I think it has great value for you, and also you can have all your tax questions answered. So reach out to us, rgtaxes.com. And again, it was a pleasure. Thanks for joining another episode of Tax Tips with Latinx Business Podcast. Thank you so much for joining me on this episode. Please take a moment to subscribe, rate, and share this podcast with your network. Your support helps our Latinx business community grow stronger with every listen, and I truly invite you to connect with us. Send us your questions, your comments, or even your own business stories to randy@rgtaxes.com. I would love to hear from you. Until next time, keep learning, keep building your business, and keep growing your business mindset.